A very welcome everyone. Welcome today to this Studium Generale lecture program. Nice to see you all here in this full-packed blauwe zaal. We've organized this lecture program today in collaboration with B&R Beurs. So for now, I would like to give the floor to Zoe Nizet. She's the president of B&R Beurs.
Hello everyone, as mentioned, I'm Zoe and I'm this year's president of B&R Beurs Eindhoven. So B&R Beurs Eindhoven is the Student Investment Society of Eindhoven, and it was founded back in 2016. Since the association has grown to over 200 members who are all keen and passionate to learn about finance and investing in particular. There are multiple events that are organized by our association. First, we have a 7-month-long investment competition with 9 different investment groups. Each investment group invests their own money and has their own investing strategy. The goal, of course, is to win the end at the competition. Then we also have weekly events on Wednesdays, which are either academy or partner events. For example, these include lectures, workshops, and in-house days. So for in-house days, we actually go to companies' offices and they tell us about their recruitment procedure and also what they do on their everyday life. Being the investment association of this university, we wanted to do an event about the intersection between technology and finance, as we also have many of our members who have some sort of technical background. That is why we decided this year to do a topic related to artificial intelligence. Artificial intelligence in the past years has been used more and more by banks and also just by traders in general. And that is why we wanted to maybe look at the risks that can represent for the society, as some people believe that it could lead to the next financial crisis. So we actually had the speaker before back in February 2016 giving one of the first B&R Studium Generale lectures as well. At that time, the lecture was about trading robots, and today he will present again about artificial intelligence and how it could or could not lead to the next financial crisis. So please join me in welcoming on stage Professor Albert Menkveld.
So thanks so much for having me here again. It's always a pleasure to come. I was talking about trading robots, like Zoe said, and so I was very interested at the time about individual agents in a financial market. In the last 10 years, I've been looking at the system. And you guys, being at this university, you know much more about systems than I do. But don't forget, in economics, we also think about systems. So what are the properties of a system which consists of elements, atoms, molecules, that are being influenced by natural forces, and because of those forces act on those elements, you get properties of the system, right? Fluids or objects, etc. That's how I think you guys are studying what you're studying. We economists, we look at economic systems, social systems. Our elements are humans, and the forces of nature can be relied upon to be working all the time, but social forces are an order of magnitude more complex. So I'd argue, the mathematics that we have to bring to the equation here is an order of magnitude more difficult than what you use in natural phenomena. Now you might, start yelling because it's an economist saying these things. But I was trained as an econometrician. The first year of lectures, we had the same tools, the same books that you guys studied, linear algebra, analytics, etc., and we use that to understand the system. And that's and when we talk about financial systems or economic systems, finance is a big part of it. And that's, I guess, the rationale behind this logo, where you have something that looks like tech lightning hitting money, financial crisis. This is Gary Gensler. It's the chairman of the SEC. So the local equivalent here is the AFM. And he's there to protect investors, to enforce regulation on actors in the market. And he's been going on this point that the next financial crisis is imminent. It's either this decade or the next early next decade, and it's going to be related to AI, artificial intelligence. And his point is that everybody's relying on some base model, ChatGPT or alternatives, like half a dozen models that operate on the same large amounts of data. So we have few models operating on the same data. And if everybody's using those few tools operating on the same data, you get concentration. Everybody sort of starts to think the same way, act the same way, invest the same way. And that's the beginning of, a growing financial crisis. Because something happens, then everybody's on the same bet, having the same portfolio, and therefore has to unwind the position at the same time, and the system melts down. So that's where we have the system contracting. That's a financial crisis. That's what he's worried about. Now, I'll give you more detail on how to think about that, and I can only raise the appetite in the time that I have here. But the slides are available, and I made sure that all those things that I'm gonna touch upon are links that you can actually click if you want to go to the deeper study. So I can only raise your appetite for this. So what is a useful anecdote to get you thinking about what type of crisis I have in mind? And for this, I'd like to go to one episode that you might not even know about, but the people from BNR Beurs might know about. In 2007, we had something called the Quant Quake. This is the returns, daily returns of a strategy of various types of strategies. One is simply the S&P 500, the returns on the S&P 500. So if you hold the US economy, essentially buy all the companies of the US in a portfolio, you're essentially buying the index. And there's returns on the index, which is the pink color here, that are typically, every day it's up 1, 2, 3%, down 1, 2, 3%, but it's very random over time. There's one strategy that went haywire in this. I don't have time to go over the other strategies. It's a contrarian strategy. And that's a strategy that was employed by quants, by people using quantitative methods to build their investment. That strategy started to look a little odd in terms of returns on the Monday, here early August in 2007. But then that strategy, the blue bars here, started to look really, really bad. On Tuesday, you started to lose almost 5% in a single day on your portfolio. And mind you, these are leveraged portfolios. So you borrow people's money along with your own money to invest in the market. Then losing 5% on a single day is a lot. But that wasn't the end of it. The next day, Wednesday, you lost another 10%. 15% down in the week. That's a lot of money. Some of the people that borrowed you money, this might be a trigger for them to say, hey, I want to unwind. I want to have my money back. And then you have to sell to raise the money. You have to sell your portfolio to raise the money and give it back to the people that you borrowed it from. You sell, you bring down the prices even more. And so you get another 10%, et cetera, et cetera. That is what's known as the Quant Quake. Oil prices reverted on the Friday. You see it's plus 25% on that strategy. But in the meantime, you might have gone bankrupt. You might have lost all your money. You might have to close down your funds. So this is the type of dynamic that I'm particularly worried about in connection to AI. Now, why is that? Well, here is one thing that I wanted to be. One friend of mine whom I studied with at Stanford, he was, like you guys, having a tech background, but he's now working for a bank. He gave me this book about Jim Simmons, who was supposedly one of the first in the market to use quantitative investments, using algorithms to decide what you're going to invest in and how you're going to change your investment over time. Jim Simmons was a mathematician. There's proofs in mathematics that are named after Jim Simmons. But halfway in his career, he turned to Wall Street. He started quantitative investing, using algorithms, mathematical algorithms, to beat the market. His firm, Renaissance, was one of those firms that lost a lot of money in the Quant Quake. This is one paragraph from the book where he talks about, where the writer of the book talks about Monday, there were some problems, but importantly, it wasn't clear who was doing the selling. So why were prices under pressure? Somebody must have done the selling, and then because somebody started selling, other people were forced to sell because people that they borrowed money from wanted their money back. And so you get this liquidity spiral, you get this spiral of selling. But what is kind of nice in this quote is that everybody presumed their strategy was unique. They were the only ones holding that portfolio. Nobody was aware that there were many, many others following the same strategy. And that's when things start to be very fragile. Because now, if there's a problem with the strategy, you have many people wanting to sell at the same time, hitting for the doors in panic. And that's where you get price spirals, like the one I just showed you in the quant crisis. Now, why is it that we don't know that this concentration of positions or concentration of the same portfolios being held by the same groups of people? How is it that we don't know? And this is where Jim Simmons quoted Benjamin, which was the donkey in Animal Farm. He quoted Benjamin as saying, "Look, God gave me a tail to keep off the flies, but I'd rather not have flies nor a tail." And that's how Jim Simmons thought about publicity, about interacting with others about what he was doing. And this makes it hard for an economist to even get some measurement of the risks that are in the system, because if every member of the system, every element of the system is silent on what he is doing, then we don't know if there's concentration in the system. So we are without any tools. We're helpless in trying to avoid the type of dynamic that I just showed you. So this was the past. This is an episode that I highlighted. But I'm using it as a metaphor to think about the future and how something like this could come back and hit us in the face, but on steroids, like in much larger magnitudes than what we saw in August. Because who cares if a few hedge funds, if a few wealthy people lose a lot of money? It starts to be really hurtful when it's your money, when it's B&R Beurs money. You know, I understand that some of you are putting your own money into this investment competition every week. We don't like to be part of that type of episode in markets, the tumble prices that we saw. It's going to hit us potentially much harder this time. Why? Because of AI. This is, in my interpretation of what Gary Gensler is saying. It's just a few models out there that we don't really fully understand how they work. But what we know is only a few. And there's a few data sources. We have Amazon, we have Google, so there's just very few providers of all this data that these large language models, these AI tools act upon. So we're sort of in a system where we're all sort of morphed into doing the same thing. And then you'd say, well, but we've got Gary Gensler protecting us. Or Laura van Geest here at the AFM protecting us. Well, Laura and Gary and all the people regulating financial markets, they don't have any control over AI or the tech companies. And that's where it starts to be a little scary. So AI models, there's few of them that, sometimes we call that hard and soft information, because when I speak to you, when I did this thing in 2016, I was pretty sure that in real time there were no machines able to understand what I was saying. I'm damn sure now that if there's an AI coupled to this lecture in real time, they'll be able to read, listen and understand what I'm saying, understand brackets and act on it. So soft information like human language, even my body language, These machines are able to turn into zeros and ones, into hard information that enters investing and other behavior. But that's not the end of it. So Gary Gensler is not the full story, because we've got volatility. That's another accelerator of the type of quant quakes that I was talking to you about earlier. Volatility meaning what is the extent to which prices move? That's what financial economists call volatility. So we have an average of returns, but we also have a standard deviation of returns. That's typically the first way we think about volatility. That standard deviation of returns is large, things are very volatile. The investment universe now is different than what it was before. Before, if there was, let's pick an example, a company that you consider investing in, making shoes. Well, you can get your hand around how much it costs to make those shoes. You start thinking about how many shoes they will sell in the future. And so you can start to think about how much cash flow this firm is going to be producing, and therefore you can calculate the likelihood of that you're going to get your interest payment on the bonds of the firm, the corporate bonds that you have of the firm, or equity, if you hold stocks of the firm, how much dividend you're going to expect the firms to pay out. That's already like kind of a hard exercise. And we have, at the VU, we have classes teaching our students on how to do that. But at least, conceptually, you know where to start. But if you think about valuing tech firms like Google, it's much harder. It's not clear where the revenues, where the cash in the future is coming from, and how volatile that cash is if regulators start to interfere with the business models of these tech firms. But that's not the end of it, because we have something called crypto. We talk about volatility. We're currently in Europe, we have MiCAR, a directive trying to protect our citizens, European citizens, against crypto. Crypto, and I've been studying Bitcoin myself, that's a currency. That's not a claim to future cash flows in what shape or form of some firm and some venture. It's a currency, it's a belief. I will only accept your Bitcoin now if I believe that tomorrow somebody's going to give me something for my Bitcoins. If I can do something with it, either sell it to somebody else or purchase goods and services with it. But the trouble with currencies like that is that tomorrow it could be worth nothing, because there's no intrinsic value. There is what we call extrinsic volatility. So this thing could be worth anything. Those of you who've been studying economic systems know about multiple equilibria, and that's the case for Bitcoin. It could be worth something and generating returns for us in fiat currency. It could also be worth zero. Like, I'm going to repeat that, zero, and it's going to stay zero if we all believe it's worth nothing. So there you have your volatility. And now we have pension funds considering buying some exposure to Bitcoin. I prefer my pension fund not to do it, actually. Anyway, so volatility. So when stuff is hard to value and you invest, you're basically consuming a lot more volatility on top. So that could be making the investment outcomes much more uncertain. But we have another accelerator, which is tech-driven social media. You all know about GameStop. GameStop was there, a firm where a large hedge fund was taking a short position, and people thought that this would be too bad if this company would go down on such heavy selling or negative opinion, essentially, on the stock. So let's start buying it. But all these investors are kind of small. But hey, we've got tech to coordinate our actions. It's really, really cheap to communicate and, tell to other retail investors in the world, unite and buy GameStop. Because if we're all buying GameStop, we're all small, each and every one of us, but together we might have a significant mass. We might drive the stock price up, and that's creating a short squeeze for that hedge fund that had a negative position. and might actually squeeze him out, because if you have a short position and stock prices go up, you have to put more money on the bet. If you don't have the money anymore, you're gonna have to leave the market. But then we have alpha persuade. This is like a relatively ugly side of AI and social interaction. If you have the time, unfortunately we don't have the time now. It's 1 hour and 7 minutes. I would love to look at this for you. I'd like to see this another time. This is a year-old video. It's the AI dilemma. They talk about how AI is good for humanity, but it's got its ugly elements too. And they go like systematically through everything that is good, but also everything that's potentially bad. And alpha persuade is halfway in the lecture. They talk about alpha persuade, where if you interact with chatbots, and sometimes there's no way for us to avoid it. Sometimes you can't call a company anymore. You're being redirected to some sort of robot chatting with you. This is involuntary, this interaction. But some of us voluntarily interact with ChatGPT and other services. When you chat with these things, be mindful that the machine is generating a lot of knowledge on you personally. The more you chat with these machines, the more they will see, hey, this lady or this gentleman is particularly swayed by this type of argument. And hey, this is an emotional button that works for you. And if you give the machine all of that list, and it needs to persuade you of something, in an evil sort of way, like buy this particular small company or asset, we call it pump and dump schemes. I'm going to take a position in that small asset, and I'm going to persuade you to do the same. Everybody's buying it. There's no underlying fundamentals, but you're all buying because I persuaded you that this company is really undervalued, and it's going to appreciate. The stock's going to appreciate, so returns are going to be positive. I'm going to sell here. I'm going to buy here, sell here. That's a decent return I'm generating off of your back. And it's just one example, but the technique alpha persuade is really, really something to be mindful of, and I think it's particularly dangerous. And then we have intermediaries. I'm looking at the clock because I also want to conclude. I'm going to skip this point, but in the market, there might be people trading on what you're doing, finding out how you're trading and trading along with you. And again, we have concentration. People trading in the same direction. Not only you as investors, but intermediaries are finding out you're trading a particular way, and they're trading the same way. And we looked at that for Vincent van Kervel and me for all the 10 largest high-frequency traders in Europe, actually around the globe, in the Swedish market. So, of course, Optiver, IMC, the Flow Traders, the large high-frequency traders here in Holland, they're part of it. But what is one takeaway of this study that we have, if you're interested, the link you can click, is that they're all doing the same thing. So their strategies, the buying and selling of securities, is highly correlated. Again, you have mass. Many agents putting their money on the same things. Fixes. Well, two things I can think about. I'm purposefully put a question mark on this because I don't have any answers, and neither do I have any of the fixes. One thing is educate investors. I'm really thankful to Studium Generale and BNR Beurs that I get this opportunity to tell you about it, because when you consider investing, either your pension, for most of us the pension fund is doing it for us, or insurance companies or mutual funds, but some of us invest personally. You have to be mindful of the nature of risk and return. And Andrew Lo, in this paper that's about the Quant Quake, actually, Andrew Lo is an academic I much admire at MIT. He says, which gamble would you prefer as an investor? Sort of a classic gamble where you get 50% chance you get $75,000, and 50% chance you get $25,000. So it's giving you an average return of $50,000 with some volatility because it's not certain. Or the second gamble that's going to look much nicer because I'm going to give you $100,000. It's more than in the best state of the other gamble. almost all of the time, 98%. Sometimes, unfortunately, I'm going to take $1 million out of you. And this is what sometimes people call catastrophe bond dynamics. Catastrophe bonds are bonds that get you a really decent yield, much more than riskless, the riskless return, or much more than you get on your savings account with ING, ABN AMRO, or wherever you are. But mind you, if there's a catastrophe, you're essentially ensuring, by buying these bonds, that catastrophe. This country gets flooded, the catastrophe bond covers that liability, then you lose all of your money. And you know, the spirals I was just talking to, the Quant Quake type dynamics, pushes into more of this type of dynamics potentially. So you have to be very, very mindful that this might be happening to your money, particularly if you add crypto and all these other things to your portfolio. So that's one thing that we should just be mindful of. I mean, I do what I can to educate the world about this. The other thing is, ideally, you want to somehow measure the level of concentration in your financial system. You sort of want to build a thermometer to take the temperature of the financial economic system. And that's what I've been doing, and I've been implementing it for the Scandinavian equities, because I managed to have data on that. Can't go through the specifics here, but what I have brought for you is this graph running from November 2009 to September 2010, measuring how much exposure there was in the financial system that compasses all of the Scandinavian equities. And you can see that, and some of you might remember, there was a steep increase. This is the top plot there, a steep increase when on May 9, 2010, EU announced that we're going to bail out Greece, essentially. So we're going to put European money solving that trouble. And you get a huge run-up in exposure to the system. And you can sort of see that in the volatility. So there was a lot of volatility in the market, which is the bottom plot here. There was a lot of volatility around that time. But that wasn't the end of the story. It was really amplified by the fact that all of the money started to pour into a bet on a single risk factor. So there was a lot of crowding. Everybody was sort of doing the same thing. And that's something that you'd want to be able to measure. So this, I labeled this crowd X, like the index for crowding in the system. Many people essentially holding the same portfolio, with the risk that if something happens to this portfolio, we have not 1, 2, 3 financial institutions, but many financial institutions in trouble at the same time. We call that, and then you can sort of think of circuit breakers. If you have this type, and I'm not saying this is the only thing to do. There's others, colleagues that are thinking of similar measures, and I don't care which measure ultimately is chosen, but I'd like to see some type of thermometer, and maybe a dynamic whereby when we see the thermometer go up too quickly, too high, we stop the market. Very much like, I know Zoe's doing electrical engineering. You have a circuit breaker in your house. If there's too much currents in the system, you want the system to shut itself off. And why not have the same thing in a financial system? And everybody has some time to reconsider their investments after getting a signal from the regulators. Because, I mean, remember where I started. I started with these individual funds don't know what the others are doing. But the regulator, at the level of the ECB, we at least have some insight into what the large institutions are holding in terms of exposures. And so at the level of the ECB, we can compute the level of crowding. And if we get a signal from the ECB that, hey, there's a lot of crowding in the system, then we could keep our bets. But at least we know that we're going to have potentially catastrophe bond dynamics to consume in the near future. Or we have time to unwind and have a cushioned or soft landing. Okay, let me conclude. It's time. 3 points. One is, and this is, my thesis that I started with, TAC has the ability, and I think it's it's happening to create concentration in our financial system. And there's a couple of accelerators that magnify that type of concentrations. And I've taken you through, at high level, through each and every one of them. Investors, you, me, we should be aware that every now and then we get the unwinding, we get the large sell-off, and we better be aware that we're going to take that hit and maybe save enough so that we can take it, or be less exposed to what everybody's trading. And finally, this is my dream, and I'm working at it with the project, the Alberto Giovannini program at the, we have something at the ECB, or I think strictly speaking it's independent of the ECB. It's the European Systemic Risk Board, where they invite academics to think about how we can protect or safeguard the European financial system. I'm currently exploring ways to see how CrowdX could be used to create maybe circuit breakers of the kind I talked about in the future. This is the end of it, and to ease a bit, break the ice a bit before the Q&A, I brought this plot. So I guess this is probably me. Economists, the low-tech people are going to find each other in the cloud. Anyway, so it was a great pleasure to give this talk. I've been pushing some arguments here. I'm happy to engage on a discussion. I think Gijs is going to organize the discussion.
Yep.
Thank you very much.
Well, thank you, Albert. Thank you for answering and discussing the question, is the next financial crisis unavoidable? Is it or isn't it? Yeah, we have some time for questions, so think about what you would like to ask Albert. But I was also wondering, maybe, Albert, you can go back to the slide about educating investors.
Yep.
I was curious, what option of gambling would you choose? So who would go for the first gamble option? Okay. Quite a large group. Who would go for the second option? What is this telling you, Albert?
So Andrew Lowe actually makes the point that there is no truth here, because it depends on your risk appetite, which one you like. But his larger point is you have to be mindful of the type of gambles you're entering into when you invest your money in the market, and that's a very important point. And so that's basically, I agree with Andrew on that point.
Okay. Who would like to ask a question? Maybe one of the members of the board of BNR Beurs? Yeah. The mic is coming your way. Yeah.
All right. So obviously, I like crypto quite a bit. So when you said that,
could you hold it a bit closer?
A bit closer?
Yeah.
Is that good? So you said that if everyone believes that Bitcoin goes to zero, it could easily go to zero, which I completely agree with. But at the same time, that same argument still applies for the euro and the dollar as well, right? Because the dollar bill doesn't actually have any value. So how do you compare that with the currency that we actually use compared to the one that I hope we're going to use in the future, which is why I invest in it?
Yeah, so let me repeat the question. So the argument about multiple equilibria for the currency like Bitcoin, and you have Ethereum, you have others, why doesn't that same logic hold for what we call the fiat currency, like the euro, the US dollar, or any other currency in the world? And that's a great question, because it could actually. And the trouble with fiat currencies is sometimes money is being printed for helping all kinds of trouble in an economy, natural disasters or even war. Create a war chest. The former Yugoslavia, there was a lot of people losing the money because the government started printing money to finance a war. And so yes, but also for fiat currency, you have to trust that your money is worth the same tomorrow as it is today. And that's why when we hear central bank presidents talk, we hear them talk about inflation and having worries about inflation and trying to reduce inflation, because inflation is basically a very negative force for the value of your money through time. But it's still a belief you need to have in the system of central banks that they're going to protect, to the extent that they can, the beliefs that their currencies or the fiat currencies are going to be worth the same or almost the same tomorrow as they are today. Yeah, great question.
Okay, thanks for your question. Maybe someone else who would like to... there's a hand going up over there. Yeah, you can just throw. Yeah, good throwing and catching. Thank you.
I have a question about the circuit breaker, because if it trips, won't that cause more chaos, that people think, oh shit, I have to leave this as soon as I can, or bet against it because it's going to go downhill?
So the question is the circuit breaker. Okay, maybe it's a nice analogy to the electrical wiring, but might not work for an economic system, because if there's no panic, then you're sort of creating panic by breaking the market and have people take a pause. And that's a great argument for why we should be careful in implementing these type of circuit breakers. But mind you, we already have them. We have them in equity markets and derivatives, some of the derivatives markets. If within a certain time frame, and forgive me, I don't know the exact details, but it's something to the tune of, if in the last 5 minutes, the stock lost more than 5% of its value, that's the time where we'll stop the market and we'll let you reconsider the orders that you have sent to the market. And you can take them out if you don't want to, you can put in new orders, and then we're going to start again after 30 seconds. And believe it or not, but people like that. Because
30 seconds, you were saying, so that's
30
that's
seconds, so you have to be real
rethink.
quick. You have to be real quick. Like, but most of this is algorithmic machine trading, like I was talking about almost a decade ago.
Yeah.
And maybe it's a minute, but so at least humans that are behind the screens can do something about the orders that they have outstanding. But people like it because they get warned about some oncoming, so they get warned about the volatility event, and then they can decide to double up on their bet or reduce their bet. But people like to be warned. So I'm not, that's the reason why on net, I'm actually positive about circuit breakers of this type.
Thank you. There's also looking at that side, but there's also here in front of you a hand going up. The person with it, yeah.
Yes. So what do you think about the perspective that AI can create economic prosperity due to automation or higher efficiency? That's the other side of the...
So the upside. So the question is, I've been deliberately emphasizing the negative side because we tend to overlook it. But I'm not saying there's no good side about, particularly if I talk to a room full of students. Some of them love the fact that you can ask ChatGPT with it for little help on some assignment, and some of that help. The position at the VU at my university now is it's okay to be asking ChatGPT and other systems for help, but you have to then make that known. So you have to basically reference that you, for the particular part of the assignment that you did, you used the help of ChatGPT. But that's, and I'm actually using it myself too for my daily work. I organized a large European conference last year, and for those of you who are faculty, you know that when you have an academic conference, somebody's presenting a paper, and then there's somebody else typically discussing, challenging what you say. And so one of the jobs of the organizer is to make sure that for every paper that's being presented, some expert is found to discuss the paper. And you sort of know lots of people to ask us to discuss it, but sometimes your list has been exhausted. And then you can ask ChatGPT something like, in microstructure, send me 10 names of people who've been particularly good in publishing their work in the last decade, young European scholars, preferably females, and then it gives you that list. But then I still make the decision myself. But it's like an aha moment, like, oh yeah, this person I've forgotten, or that person I've forgotten. So yeah, there's a lot of good out there. But there's also, but we have to be mindful of also that. I mean, I have 25 minutes, okay? So I needed to emphasize the challenging parts of AI here.
I was wondering, Albert, because for me it sometimes feels that we quite easily recovered from the 2008 financial crash. What will be the impact of this upcoming crash?
Well, you say that much too easily, because lots of people have been hurt in really magnificent ways at the financial crisis, like losing their house, moving their families, losing their jobs. So these people will remember all the negative stuff that came out of the crisis. So I'm worried. Maybe the majority is able to recover, but there's still the other 50% that's heavily hurt by this. Yeah. And this is the same thing here. If you're not aware, some people with lower, sometimes call it financial literacy. With lower financial literacy, they might be particularly prone to put yet another euro that's meant for their pension onto this beautiful crypto that's being advertised by this influencer in this TikTok video. And that's where it starts to be really scary. So I want my regulators to max out on warning people about there's nothing inherently valuable behind them because of the fact that it could be worth zero tomorrow if everybody decides it's worth zero tomorrow. Relative to firms that have actual production, that have actual goods services being produced. And sometimes we get so lost in the moment that we forget that.
Okay, Albert, thanks for answering these questions. Thank you for asking the questions. Please give him again a big hand. Albert Menkveld.
Thank you very much. Thank you. Thank you. Thank you.
And if you still have questions, please come forward, and hope to see you next time at Studium Generale.